Hi guys, my name is Toby Mathis. I'm one of the founders of Anderson Law Group, and today we're going to be talking about how to use a nonprofit for maximizing everything from tax savings to asset protection. It's kind of weird that we're going to be talking about using a nonprofit until you understand what it is they actually are. A lot of us are used to hearing the term 501c3, and that's because that's the section of the code. 26 USC is the Internal Revenue Code, so it's 26 USC 501, that covers exempt organizations. And C3 just happens to mean the types of organizations where you get a deduction, a charitable deduction for giving it. So this is going to be religious, education, and charitable organizations that are doing things to help society. The easiest way to conceptualize this is if the government could be doing it, but I'm doing it, then chances are it's going to be something that I could run under a 501c3. So lots of 501c3s that you know about are like hospitals. There's lots of educational companies like Harvard. All the major universities are actually nonprofits. And then you have the United Way, the American Red Cross, all these. The NFL, up until a few years ago, was a nonprofit. There are people that provide housing that's low to moderate income housing, or housing for veterans, or housing for single moms. You fill in the blank. If it's helping out a group, then chances are it qualifies as a nonprofit. That's a topic for another day. We could just talk about real estate with a nonprofit. But I just want you to understand that this is the section. The way it's set up, and I always put it into three categories. Number one is the state. That's what do the states view it as, and what do I have to do with the state to create something? The next one is third parties, and then the last one is the federal government or the Iras. Easiest way to look at it. I use the Fed because I like saying state and Fed. So what is a 501c3? It is a nonprofit corporation set up with the state, and a corporation has bylaws. And ordinarily, a corporation is going to have shareholders. The biggest difference between a nonprofit and a for-profit is a for-profit is there to profit an individual, give money and make money for individuals if you're shareholders. In a 501c3, we don't care about the shareholder. It's for community benefit. So there are no shareholders. There's just directors. So we have the bylaws, and then we have directors. Now, you buffs out there that love law know that you could also have board of trustees or regents or all these other things. At the end of the day, there's a governing body. There's no owners of a 501c3. And then to the IRS, it's just an exempt. So the easiest way to think about that is you don't pay tax. And if you don't pay tax with the feds, you don't pay tax with the states. And this goes for like a lot of different things. Sometimes you can be exempt from real estate taxes. Sometimes you can be exempt from sales taxes. There's all sorts of exemptions. But the one we care about the most right now is that federal taxes. So we can avoid taxation with a nonprofit. So when you set up a nonprofit, set up with the state, you create a body for it, which is the bylaws, and then you submit all that to the IRS. And technically, if you want to follow along and be a little bit nerdy, it's a form. It's an application. It's a 1023 application where you're trying to get exempt. You wait to get your exemption. Now, here's the beautiful part about a 501c3. 501c3, remember, this is approved, and it could be a year, it could be 2 years. If sometimes they ask a lot of questions. For us, we've done over 3,000. We're typically within the 6 to 9 month period. It relates back to the date that you set up the corporation. This is really important because if you're doing tax planning before the end of the year, you could literally set something up during the year, fund it, receive the tax benefit, and be applying for your exemption, and it'll relate back to the date. And we've never had one not receive its exemption. So I could say with almost 100% certainty that you're going to get your exemption. Depends on what you're doing. If you're doing something that's in the wheelhouse of things that have been done before, 100%. If it's something that's novel or new or kind of crazy, then, we have to get through the question and answer with the IRS. Now, here's why it's important. Whenever you're doing tax planning, it's kind of like this. We're going to have different categories that we could fall into. So we're used to being, I'm going to pretend this is people. This is a family. we're used to W-2 wages where it's just taxable to us. And we think, oh, there's not much I can do for tax savings. I know that I have this thing called Schedule A, which is itemized deductions, but it has to exceed my standard deduction, and you get onto the tax mumbo jumbo. If you're an individual, you may not have a lot of options. If I'm a business and I'm a 1099 or I'm receiving a K-1 through something like an S-Corp, now I might have some options on moving some money around. The first thing we look at is other taxpayers. So as an individual, our other taxpayers that we have the option to give money to that we can still deduct are things like IRAs, or what are called qualified plans, or 501c3s. When I'm a business, and let's just say that this is an S corp, so this is an 1120S S corp, and that I am just an employee of it. Now I have a little S box that can do something else. That could actually pay maybe my child, maybe my kid, maybe somebody else that's working within the business for me. I can pay them W-2 and I can write it off. And then they can go ahead and fund things. Now, because I'm a business, I get a different type of retirement plan. I can actually use a 401k, which allows me to defer up to $18,500 of my wages in this year. And then if you're over 50, it's add $6,000 to it, so it's $24,500. So we have some other choices. Now here's what's cool. If you're the S Corp or here, we still have this 501c3 that we can always contribute to. So we have other tax brackets that we can use. And this is where it gets very, very important in tax planning. This is called income shifting. Rather than have the money hit me personally, let it hit somebody else's return. This is an exempt organization, or that's an exempt entity, the 401k. This is an exempt. So if I put money into it, I'm not going to pay tax on it. In fact, I'm going to get a deduction if I do it right. Same thing here. No tax, all I get is a deduction. Here, that's just a deduction. But here, this thing can still grow. This thing can still grow. These are very powerful tools as a result. If I give money to my child, they can spend it however they want, but they still have to pay tax on it. These guys don't. So I'm pointing to you to a few where I get a deduction and it doesn't have to pay tax on the receipt of that. Now, before you go, oh, Toby, that's really neat and dandy, but why do I care? Well, because as of 2018, I can write off up to 60% of my adjusted gross income. That's a pretty powerful tool. So if you make $1 million, you could pen a check to your 501c3 for $600,000. And if it's an organization that's doing something like, again, I'll use an example of low to moderate income housing, I can write off the entire $600,000. Now, a lot of people say, oh, that can't be. It's been done for years. In fact, we have a president that took advantage of something very similar in a conservation easement that netted him, to mean quite literally, on just Mar-a-Lago. It was, I think, $6 million plus was the deduction on doing what's called a conservation easement, which is giving it to an organization that's a conservation organization. He gets the difference between the fair market value and what it's worth when you give the restriction on the use of the property. You don't have to remember all that. All you have to know is that you get big tax deductions. You can do that too if you want to. And it just depends on what your appetite is tax-wise. It's one of the few ways where a W-2 wage earner who's making a lot of money could have a very positive impact on their tax bill by pushing it down. Now, the other reason that 501c3s are so potent is because nobody owns them, you don't own it. So they can't take it away from you. So from an asset protection standpoint, it's a very, very effective tool, because no matter what's going on out in your life, if you have a child that's exposed themselves to amazing amounts of liability that you're going to be responsible for, this is something that no matter what the size of the creditor is, no matter how vicious a lawyer they have, and no matter how hard they come after you, this is something that you will always control, but they can't take it away from you. And for some of you guys, you're doing social good, you're using this stuff and you actually want to help people, you're helping organizations, and you don't realize that you could run that as a nonprofit. Now, this is where it even gets more potent. Just to throw one more thing at you, is that when we look at the 60% of adjusted gross income, that's if you're giving cash. You could also give property. And the way it works is if you give long-term property, like let's say a house that you fully depreciated or something along those lines, that 60% goes to 30% if it's long-term property, but it's the fair market value. So imagine you bought a house for $60,000. Imagine you depreciated most of that house. So it had had the land value, but then you depreciated it over many years, and you have almost no basis in that property any longer. It's down to its tax basis is like $10,000. You could give that house, and whatever its fair market value is, let's say that the house has gone up from 60 and now it's worth 200,000. That's your deduction. The only limit is 30% of your AGI, which means if your adjusted gross income is $1 million, your maximum amount you can write off from that type of deduction or that type of gift is going to be 30%, so $300,000. So you would get the full amount in that year. Now, if you ever exceed the 30% or the 60%, you just carry it forward for, I think it's the carry forward is about 6 years. So you just carry forward into future years and continue to knock it off. So I hope you're seeing, like a few of you guys might be going, this might be interesting. I have a bunch of rental properties. Do you mean that some of these could qualify as a nonprofit? Yes, and we could actually contribute them. We would get a fair market value deduction. The nonprofit now owns it. The nonprofit could actually go to the state or the county where it's located and seek an abatement of the real estate taxes it's paying and watch your cap rate jump up. Some of you guys that are real estate savvy understand what I just said. The rest of you guys, just know that it's a pretty effective tool and it's worth learning more about. If you want to learn more about it, spend some time on our website or absolutely come to one of our nonprofit workshops.